How is inflation impacting lower income households? Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial. And in this edition of the Econ Market Minute, I want to give you 3 insights about spending behaviors and what this might mean for the markets and for the economy. So first, high food and rent prices are a concern. So as we all know, food prices are one of the most concerning categories of inflation right now. Headline inflation has turned over, but not so much food and rent. Those categories have yet to peak. Beef and dairy prices up over 20% since the beginning of the pandemic, and chicken prices are up over 30% since the end of 2019. Now, more recently, we've seen an easing in meat prices, but eggs and cereal are still increasing. We've talked about the nuanced aspects of today's inflation environment, and so now more than ever, we need to break out the components to understand the underlying trends with inflation. Second, rising food prices have disproportionate effects. We know rising food and shelter costs have those disproportionate effects on consumers since lower income households spend a larger share on groceries and rent. The percentage of spending going to necessities such as food and shelter varies widely across income demographics. For those in the lowest income quintile, over 11% of spending goes to groceries, while those in the top quintile, only 6% of their total spending goes to groceries. That's roughly half the percentage. Similar story with housing. For the lowest quintile, over 40% of total spending goes to housing. We know many of the lowest income quintile pay rent, whereas those in the upper income quintiles own a home. So as rent prices increase, we should expect more of a squeeze on lower income budgets. Overall, rising shelter costs are heavily concentrated on the lower income households. And this is important to remember as some retailers have particular exposure to this client base. Third, import prices will eventually push down consumer inflation. As the dollar is historically strong, we expect import prices to soften. As shown in the graph, we often see a leading relationship between import prices with future moves in domestic consumer prices. Same thing holds for producer prices as well. So the Federal Reserve has a lot more work to do in removing the loose monetary policy that contributed to this quagmire. But as financial conditions tighten, we should see consumer prices ease in the coming months. Of course, the biggest risk is that global headwinds make a soft landing more and more difficult. Well, that's all for now. Continue to follow me and the LPL research team on social media, and take care.